Good morning. It is Wednesday, April 9th, and we're 30 minutes before the market's going to open, and the markets are likely going to open in the negative. We've had a pretty tough time on the stock market for coming up on 2 months, and the selling is not going to stop. Yesterday was quite a dramatic day on the NASDAQ itself. The NASDAQ went down more than 7% intraday, which was a big move. The market started off in rally mode, but then in the middle of the day, just sold off hard. And it ended um, in the negative, but intraday, that swing of more than 7% is pretty violent. That's pretty harsh adjusting right in the middle of the day. Year to date, the NASDAQ is down um, 20.94 overall year to date, but from the high to the low, we're down almost 24%. We are in a bear market for the NASDAQ. The S&P is in a little better shape, but it's not doing all that great. It's down 18.9% from the high to the low. So just one more push, and maybe today gets it into that bear market territory. So the markets are reacting quite violently to the tariff war, and the reaction, how quickly stocks have really sold off, and how bad things have gotten really quickly, I think is somewhat a good element to it all. If it happens very quickly, then people can associate cause and effect. The cause of the market selling off are these tariffs, and these tariffs may be a good thing in some ways, but most definitely it's been a very negative impact on a lot of investors. And let's kind of color in what an investor is. It's a 60-year-old person that was looking to retire. It's a 25-year-old that's looking to grow their wealth. It's, these are human beings that are investing their money, their hard-earned money, and looking for that money to grow. We have had a stock market that's really worked for a long time. And part of my American dream is being able to invest and grow my wealth. I've worked pretty hard for my money, and that's what's great about the United States is we get to invest our money. And I think this is really scary for many, many people in the United States, and yours, yours truly included. I don't like seeing markets sell off this fast. It really causes, I think, a lot of collateral damage. I think some investors will get out, stay out, and so forth. But I think this tariff war has really gotten ugly, and it's gotten really scary to a lot of people. And you think about the retired person that's sitting on a bond fund, and the value of those bonds keeps going down. That's got to be scary. So we will see how quickly this tariff war will get resolved. If we're in this thing for a year, man, it's going to get really ugly. If we can get this thing solved, maybe in the next 30 days, we're going to see the market recover some. I don't know that we're going to end 2025 with a green number. I think it's going to be red because we've dug a hole in the market. Now, overall, the market was expensive. Okay, let's keep an eye on the fact that, for a couple of years, the market was just in go gear. Like, just let's go up 90% over 2 years. So can we give up some of those gains and still be, overall in the positive over a 5-year chart? Absolutely. But once we see that drop now over, call it 2.25, 2.5 years, we're up 45%. So the rate of return's now looking at 15% versus 45. So 45% rate of return is phenomenal, but that's just not sustainable. It's just not going to happen. It shouldn't happen. If the stock prices would just be really out there if that happened. So a good quality correction market is really fine. But what we just don't want is we don't want to stay in a prolonged bear market, like for 2 years, for 5 years, because that really can impact, the investor that's looking to retire, and now, oh, I'm gonna have to work longer because my investments I thought were gonna have a rate of return that'd be in the positive, but a third of my portfolio is gone because of this extended bear market. So that's what I'm hoping we avoid. Good diversification is important. And I'll speak to a lot of the things that we ought to do as investors. You do it when it's you, it's really not a necessity. For example, investing in bonds when times are great and nobody cares about bonds, nobody wants bonds, stock market's going up. Why wouldn't you put, more dollars in the stock market? We need to have the discipline of saying, because when this time happens and you have a down market, I want to be holding bonds. I want to be holding something that's going to preserve that part of my wealth. So right now is not a great time to overly react and say, "Oh, whoa, I got to go 100% into bonds." Well, let's kind of slow down a little bit. I've been buying into stocks. On these down days, I'm buying stocks because I believe in these companies that I'm buying into. And I think these companies over the next 5 years are going to do really well. And I think as an investor, I will be rewarded with a good rate of return if I find good businesses and invest in them. I try to find businesses that are valued below intrinsic value and invest in them. And it may take a while. It may take a while for that investment to go up in value, for the market to realize, hey, that company's worth a lot more, and then for that stock to work. But that's my investing strategy, and I'm going to stick to it. So right now, I'm actually buying stocks. So we'll see how the market behaves. But it is weird to have a market that is dropping in price, and at the same time, interest rates go up. There's usually a natural stocks prices go down and interest rates will go down with that. That hasn't been happening for like 3 days, going on 4 days. That's really unusual. It shows that the money invested in stocks that's leaving, that's why stocks drop, the investors sell, is not going into bonds. It's going into savings accounts. It's maybe leaving the US market and ending up in, Asian markets, China, Japan, or other markets. It's a it's a very short term, a trend that I'm seeing, but it is something that's caught my attention. Is why are it's markets are not behaving like they naturally typically do. So it looks like Shadow Guy's out there. Very good morning. Hope you're doing well, Shadow Guy. Wanted to take a peek at Asia. Something that came up is that Shanghai, which is the Chinese stock market, it is up 1.31%. And what happened overnight is that the US increased tariffs since China retaliated our tariff increase. Um, China increased their tariffs twice. They increased their tariffs, and the U.S. has increased the tariffs on China. So the escalation is happening, and the most recent increase was on the Chinese side, and their market went up. Now, um, it's a theory of mine, which is, China may come out of this in a better position globally because they didn't start this tariff war, and they may have better relationships with Latin America, Europe, other parts of the world where they can do more commerce. So if you look at an Alibaba, if you look at the manufacturing companies, they may be um, increasing the amount of commerce they do because they're not kind of the troublemaker right now in the world. And they're probably, it's kind of the US is, it's, it's the US against everybody right now, unfortunately. And China's kind of part of the everybody crowd. So they're probably increasing their commerce from China to other places. To me, that's a concern. I'd like to see the U.S. do commerce with everybody, and add value to the world with our products and services. And you think about AI, right? So the U.S. had a big lead in the AI area. Um, we had OpenAI, we had Google with Gemini and their large language model. Meta AI is really looking good. But then DeepSeek came out. That's a Chinese large language model. It's a uh, AI application provided by DeepSeek, and now Alibaba's come out with their AI. Very impressive large language model and application. And so now the rest of the world, are they going to develop on US based AI platforms, or are they going to go with the Chinese? Right. Well, this current condition where there's hostility, the hostility was started by the US. So that might impact, let's say just picking a continent, the continent of Africa is like, hey, we're going to want AI, the countries within that continent, we're going to want AI, and we're going to go with a Chinese, platform. And we think that they're a better partner because they're not hostile. They're just out to have good economic and commerce related relationships with companies. I don't know. I'm not a global economist. I'm just a guy, and I do have a degree in accounting. Plenty of economic courses were taught in that degree, and I have a master's in business as well. A lot of business experience, and that's my best observation. So we'll see how things play out. Specifically to stocks, looks like we're going to open in the red, and we're going to keep this sell-off going. Crypto was holding up, and it's still holding up okay. It's at $76,825 per coin. That's not bad. And as I look to gather more cash, I'm going to be selling some of my bonds and probably selling some of my Bitcoin. I was thinking of selling some of my Bitcoin just to have some more dry powder, because I really do like the prices on stocks that I'm seeing. In all this scary, situation, stocks are looking better and better. I mean, I'm looking at some stocks that are really nicely discounted. They're terrific businesses. I'll highlight some of them on this live stream, and it makes investing, I think, more easier, and it makes it so that I could find discounted businesses far easier than we could, 4 or 5 months ago. Businesses were really, really expensive. So that is where we're at with crypto. And so that's the markets overall. Now, interest rates are really climbing up. So mortgage loans are going down a little bit. So these are economic indicators that were reported, and the number of applications that we're going to see for mortgages is going to go down. I imagine because the interest rates are going to go up. The big stories out there, like Jamie Dimon's calling for a recession. I agree with that. I think a recession is pretty much going to happen. I think that, part of recessions is you have periods of economic growth. And we certainly had that, especially with the stimulus money that the government put into the economy due to COVID. I'm not arguing that if that was a bad idea. I'm just saying you had a lot of artificial um, stimulated economic growth in that period. We don't have any more stimulus dollars. We shouldn't have any more stimulus dollars. I think that's what caused a lot of the inflation. And now the economy has to operate with that type of compare. Hey, we had an economy that was growing, but maybe not growing due to its production and its output, but rather the government stimulating it. So now we're dealing with a slowdown. Slowdowns are okay. We got to have a recession just to set a foundation for growth. So, uh, good, good, solid, recession. Now, when recessions happen, profits for companies go down, growth goes down, stock values come down, and I would say the investor sentiment comes down. So we'll see that markets will trade lower and so forth. And again, it'll be a great time to invest in stocks because if you're a long-term investor, you buy low, you hold, you make lots of money over time. So a recession is not completely a bad thing. It is a normal cycle. So those things are going on. Companies are beginning to adjust their guidance. And I'm going to look at Delta closely. And Delta is not exactly like a good example for tariffs, but Walmart certainly is. And they're pretty much getting rid of their forecast. They're like, hey, we're not sure what's going to happen. And I saw another story that makes a lot of sense. We celebrate Christmas here in the United States. We celebrate Christmas in my home. It's fun, but I would say like 90% of the products are made in China. And I can't find the story right now, but I think Christmas, the Christmas product companies are saying they're getting 0 orders from businesses, retailers for the 2025 Christmas. And because everybody's freezing, like, okay, are the tariffs going to be around in a couple months or should I wait? Because if I buy the product now, bring it in, put it in inventory, and especially the tariffs on China, they're really high. Am I setting myself up for a huge loss? Because if the tariffs go away in a month, then my competitors, they're going to buy the product at like half as much. And now they can sell it for Christmas, at half the amount. So it's putting a lot of businesses in a holding pattern. And that obviously is going to cause a recession. So it's a dicey place to be in. So that's what's going on out there. When we look at yesterday's performance, just a heat map, again, yesterday we started the day in the green and it was fun while it lasted, but then it just got red. Apple is, and I'll show, Apple lost its number one spot as the most valuable company to Microsoft because the stock's been dropping so fast. Apple has not been growing their revenues. They've been pretty much flat for some time. It's not like, 1 year. No, it's like 3 years. They've been single digit, very low growth, negative growth, single digit, but they've been expanding their profitability. Well, that profitability is going to be under threat because the tariffs, Apple, to make their devices, they depend on China. They're not going to move out of China in the next 10 years. It's just be impossible. There's no other place on earth that can support the production of Apple products. And same thing for Hewlett Packard, same thing for all these electronics companies. China has the manufacturing complex for electronics. You can't manufacture electronics without China. That's just the way it is. It'd be like, something that the US is dominant with is agriculture for some certain categories. You just can't grow food in all parts of the world. It has to grow in a region that supports that particular food. So the manufacturing for electronics happens in China, and Apple's right there, like right in the middle of this whole mess. And I'm sure that, Warren Buffett's a huge Apple stockholder. Is he going to buy more Apple shares? I don't think so. I think a lot of investors are selling out of Apple because they're in no man's land. And Microsoft is kind of the company that's not losing as much value. When you compare Microsoft, only Meta's doing better from the big cap stocks. So now Apple's in second place. Microsoft's the most valuable company. And then NVIDIA has dropped over $1 trillion of market cap value in 2025. Excuse me, in the last 6 months, I should say. That's huge loss of capital. I mean, over $1 trillion of outflows in the NVIDIA stock. So these were correcting markets. NVIDIA was too high to begin with. The whole AI bubble and the whole data center build out, it was being built on a fantasy. And this, times like these, it does kind of highlight or shine of like light on what are real businesses versus not real businesses. Now that times are tough, nobody's talking about AI. Nobody wants to even bring it up because it's not a real business. Nobody's making money on AI. The companies that are selling in the data center are, but now that companies are freezing their CapEx, NVIDIA is going to continue to drop. I've made a video recently. I think it's going to test $60 per share, which is a big haircut. They've already gotten really reduced in price. And Broadcom's in worse shape. Broadcom had a rally because they announced the stock buyback, and that's a really bad idea. I was a Broadcom stockholder for some time, sold, and I know their balance sheet has a lot of debt because they acquired a business and they used debt to acquire that business. Well, when you have a high balance of debt, you don't buy back shares. You should be using that cash to pay off your debt. Rates are going up. So Broadcom's announcing a stock buyback to try to stop the bleeding. Their stock's down, 40% in the last couple months. And it may work temporarily, but it makes the company weaker for the long haul. That's worse. If you're an informed investor and you look at their balance sheet, you're like, you're doing the wrong thing. You should be paying off debt because you have a lot of debt. So we'll see how things play out for Broadcom. The one hot spot, or green spot, I should say, is health plans. They did well because Medicare, the announcement was made that the reimbursement rate on Medicare is going to be better than expected. So the health insurance payers rallied. So it's good to see those rally. And aerospace rallied. Just a couple spots of green. Everything else was either red or some variation of a shaded red. But some stocks kind of held it together. It looks like Salesforce held it together okay. And we'll see how today sorts these out. As mentioned earlier, Microsoft is at the moment the most valuable company on the exchange. And it's probably seen $500 billion of outflows. Year to date, it's down almost 16%. Apple's down 31%. Oof. And I've been saying on the Apple stock for some time. I mean, I've got videos on my channel to reference my comment is it's been overpriced for a long time. And not severely overpriced, but it's been overpriced. It's just kind of a business that's not growing. If you're not growing, there's no excitement for me. It's just a dead stock. So it's now beginning to really get hit. And NVIDIA obviously has been hit hard. And I think it's gonna go down more. It's probably gonna test $60 a share, which is going to be, in essence, if you look at their market cap is going to drop to 1.4, 1.5 trillion. That's my expectation. If you look at their intrinsic value, that's where I put them. Amazon's been, their price has been reduced. Google's a good buy for me. I think the price has been reduced, but Google's going to make it through this quite well. You think about how strong their products are. You guys are either watching me on YouTube or one of the other streaming platforms. YouTube isn't they're not going to see users, not view YouTube as much. They're going to see more. YouTube's the best deal on the internet. It's free. So, and their search is going to continue to work. The whole AI bubble either bursting or losing its air. We go back to who commands search, who's number one in search, Google. So they're going to be fine. So I like their pricing right now, and I like the pricing of Meta. Meta's in a great spot. Berkshire is picking up investors because it's a safe place for investors. And Broadcom is down 32%, and I think it's going to continue to drop. Probably drop down to 500 billion in market cap at some point or lower. Tesla's just been destroyed. It's down 45% year to date. That's got to really hurt. So that's what's going on there. Just to kind of highlight super investors. Investing's tough. The S&P is down 15%. Michael Burry is leading all super investors that I track. I track 11 of them. And this is somewhat updated real time. And Michael Burry, he's down 8%. Not bad compared to the 15 that the market's down. Tepper is doing better than most at 10%. Carl Icahn, I just evaluated his portfolio, and he's doing better than the S&P. Look at that. Howard Marks is lagging the S&P. Warren Buffett, and this is the portfolio that Warren Buffett runs. It's not the Berkshire stock. They don't own their own stock. They own other stocks like Apple, Chevron, and so forth. So when I look at that portfolio is down 17%. Lee Lu down 18%. Druckermiller down 18.7%. Ackman down almost 20%. Dorsey, my favorite investor, down 20.7%. Manish Pabre down 33%. Kathy Wood, she owns a lot of Tesla, down 34.7%. Brutal. You give a professional money manager your money and you pay them, and they have this going on. Now, this is a market that, who would have thought that we'd be selling off this fast, right? It's caught me by surprise as to how fast. I mean, I don't think tariff policy is a good idea to have a capitalism-based country with free enterprise kind of principles. Tariffs are not a good idea. So you would expect that the market's not going to like it, but for it to go down as fast is surprising a lot of people, including these super investors that are paid a lot of money. A lot of these guys have made themselves billionaires by getting people to pay them money to manage their money. And the result, this is why, for a while, I paid a professional money manager and I was unhappy with the result. I did not outperform prior to working with that money manager. I did fairly well. I hired a money manager and there was no improvement. It was actually, I did worse and I was paying him. And I'm like, what's the sense of paying somebody if you're going to do worse? So if you are investing in yourself by becoming a better investor, understanding what's happening in the markets and doing better for yourself, that's a great investment. You're going to make yourself smarter and you're going to make more money over time. By parking your money with one of these money managers, I'm not saying it's a bad idea for everybody. Some people may want to do that. Some people may just not want to do the analysis. Okay, that's fine. But it's not guaranteed that, hey, I'm going to hire a professional money manager and they're going to do better than the market. Nope. And they're going to do better than me. Nope. I'm outperforming most of these super investors, and I continue to get better each month. I can continue to get better each year, and I'm empowered with good knowledge and ability to invest right. So keep at it and making yourself more valuable, smarter. You want to increase your ability to to invest. join the channel. You can join at 3 levels. You just go to the homepage for the channel. You just click on my icon. You come here and you become a member. You'll get greater access to the live streams. You get to ask for stocks to be reviewed. There's 2 ways to get stocks reviewed on this live stream. Is if you're a member, put a stock out there, I'll analyze it. We'll go deep on it. Or you can buy a super chat for $5 and I'll analyze the stock. You can buy a $10 super chat and I'll analyze 3 stocks for you. And then the other thing you get as a member is you get access to the tools I use, as well as a library of all the analysis I do throughout the month. And you could see, where I landed with an intrinsic value for stocks. All right. So let me check on comments, and then we're going to look at Delta earnings, which were the one set of earnings that I wanted to take a look at. And we'll look at the Simple Good Foods company as well. They announced interesting little company, and they are a consumer staple, which those stocks have been doing well. They've been doing well in 2025. So it looks like Shadow Guy is on. Magical Self, good to see you. Omar, great to see you. Brian, thanks for joining. I appreciate it. We're 42 strong on the stream. Thanks, everybody. Hopefully you're having a good morning. The market did open. Let me take a peek and see what's going on. It looks like the NASDAQ is up a tiny bit. S&P is down 0.5. And the Russell takes a little while before it gets updated. So we'll see where that goes. But for now, we're going to take a look at Delta. So, of course, Delta is an airline. Their stock is up 4.82%. And the company, it's a $24 billion market cap company, revenue of $62 billion, forward PE of 6. The market doesn't pay up for airlines. Airlines historically have been a tough investment. They tend to not have long-term value creation. It's not like, over time we've seen the Microsoft company just continue to get more and more valuable over time. And in the case of Delta or United or American, they have periods of time when they go up, but then they come down. And that's been the case for Delta. If you look at their stock chart, they had a real good period of time from August through very beginning of February. The stock was up 85% in just months. But since that time, and once we saw that, hey, the airline industry is really seeing a lot of loss of demand. Travelers are not traveling because they're afraid of this recession or concerned with it. The stock's down 45%. So you gave up all those gains. Within the year, you're back to even if you invested at that perfect low point. But over the 1 year, the stock is down 21%. So it's a tough investment to figure out. So is this stock, worth considering? Well, let me show you the valuation that I performed for them overall, and I'll get to that conclusion. So the company has been growing. It's got top line growth, which is good. Over the last 4 years, it's grown its top line revenue, and it has been profitable. It has generated free cash flow. Now, this is an industry, again, it's very cyclical. You'll have, for the period of, I would call it 2023, 2024, you had a lot of pent up demand where people were locked up during COVID. You have restrictions on travel. People didn't want to travel. They're like, oh, I don't want to catch COVID. I don't want to travel and catch COVID. That wouldn't be a fun vacation. You go somewhere and you get sick and you have to, wait it out. So people didn't travel. So going into 2023, once restrictions were lifted, 2024, people traveled to make up for the 2 years that we couldn't travel. I get that. I traveled in 2023. I went to Europe with my wife. We had a great time. And we, you know, cost was no object. We wanted to catch up on some travel that we wanted to do. I traveled to Mexico, extended travel to Mexico. I've traveled to the Northeast with my family. So all those trips, they felt good because, hey, we hadn't been able to travel. But now with the economy heading to where it's heading is, I think consumers are going to be real careful with their money. So I think this cash flow is going to come down and their revenue is going to come down and their margins are going to come down. The one thing that is helping them is that oil prices have been coming down really fast, and that's going to lower their fuel cost, which is going to make it easier on them. But they still have to hire all those people to, fly the airplanes and all the personnel that are at the airport that help us get on the airplanes and so forth. They still have to pay for all of that. So their growth has been okay. Now, when we look at their balance sheet, they do carry some debt. They have $23.38 billion of debt. They do have some cash. So net debt's $19.67 billion. When we go debt to EBITDA, they're at 2. Not bad. So some analysts think, hey, this thing can go up to $85 a share. And some analysts think it's 42. Now, these analysts are probably thinking the market's going to price this company at a PE ratio that's going to be, somewhere in the average for the exchange. That's just not going to happen. It's an airline. So the PEs are going to be really low. Look at these forward PEs. 5, 4, 4, 3. Geez. The market just doesn't like airlines. And that's just a fact of life. If you can catch it and then see a nice rise and then sell, would be my plan. They're going to have good profits. Assuming that demand doesn't collapse. They're going to get good. They're going to have good profits. So let me show you the valuation I put together. And before I do that, I did look at their earnings. I read through them this morning just to kind of get my head around the earnings. Things look okay. Their free cash flow looks okay. They are spending a little more in capital in the market. So that looked okay. Looking at a valuation, I put together a forecast, and this forecast was tricky because their current year free cash flow is fairly good. I just don't think they're going to keep that number. I think that number is going to quickly go away. I'm actually going to change that to minus 15. I just think it's going to be a hard time for airlines. The demand is going to go away, and it's going to stay away until this economy starts getting better. The other thing too is, the travel, I think that it's less comfortable, especially for Americans to travel abroad. I think there's a little bit of a tension with Americans right now. So there's just some things that are going to cause people to pause their travel. And so this is going to go down by 15%. I'll change this number to 85. When I put this section of the model, what I'm doing is this is a forecast. This is you making decisions. And in this case, it's me making decisions on where I think the business is going to go. What's my best estimate using qualitative decisions, like what's happening with travel? It's really slowing down fast. What's happening with the economy? It's going into recession. Are people going to want to travel? Probably not. They probably want to save their money. They want to wait this thing out. Like, we don't know how expensive things are going to get with these tariffs. Our car is going to go up, 25, 40% in cost. And maybe your family needs a new car. So you're going to start saving up for that. Or, the incidentals, apparel. Is apparel going to go up in price? And you have young kids that are, go to school, so you need to buy them clothing. Or are you going to be paying more when you go to Walmart and get clothes for your kids? So all those factors are going to weigh on people's decisions to travel. And I think the travel industry is already feeling it. And they're going to continue to feel it. So I think free cash flow is going to slow down over time. I'm going to use a higher discount rate, which means I think they're riskier than, let's say, a Union Pacific, which is super stable, or even as high as CBS, which I would argue they're riskier than CBS, but let's carry on. So I think 8.5 interest rates are rising. I think Delta is a riskier company because they have to put so much darn capital into the business in the form of these airplanes, which cost a lot of money. So 8.5 discount rate. So when I look at the free cash flows, the forecast that I have for the future, I get to an intrinsic value of 29 billion using this discount rate. And I'm going to add cash and take away that debt. And I get to an equity value of 9.3 billion. The market cap of the company is 24 billion. So this stock is priced well above its intrinsic value. So it's a no-go for me. I would sell Delta stock. I sold my United stock at a gain in late 2024. And I'm staying out of airlines. It's just too risky, really risky. The earnings per share, and this is why Charlie Munger would not look at earnings per share, is it gives you a whole different picture of the company. And I'm going to change that to 6, which is what the market's willing to pay. Earnings per share say, no, the price is fine. But this is the number that Charlie Munger would really focus on, is the intrinsic value based on free cash flows, and then making a decision. Because over the long haul, this is what the market will weigh as the value of the company. And that's what I weigh most. And that's where I make my decisions. Rarely do I look at a company and say, well, I don't care about free cash flows. I think the earnings per share are going to overshoot the mark so well that I'd rather be a part of it. One exception would be a high growth business. If they're growing really, really well, and I expect in 3-4 years, cash flows will be good then, that'd be the exception. But in this case here, it's just a no-go. It's a sell. It's risky. There's not very good upside over the next couple of years. And I'd rather just stay out of the stock. So that's my opinion on Delta. I think it's a no-go. It's interesting that the market is bidding up the stock. I'll let somebody else invest in Delta. I've been an investor in United, and United did well. But you see this correction here. I don't want to be a part of that. And it's really, really corrected hard. Made investors lose a substantial amount very quickly in, a month and a half. The stock's down 40-45%. That's a real crushing depletion of capital. Look at that. The market is rallying. Now, is it going to play tricks on us today? Is it going to go up and then fade? I don't know. We're in a bear market, and I'm not seeing the big picture problems being fixed, which is, when are these issues around tariffs going to be resolved? The market's not going to go up. It's not going to trend up long term until the tariffs get fixed, like decisions get made, and we know what's going to happen. So to see this, increase here, it's not a bad day to trim here or there, which is probably what I'm going to do. I'm going to trim a couple of stocks where I can create some cash, and I'm not going to buy stocks, that have gone up in value today, or price, excuse me. So that's what's going on in the stock market. Interesting. And if we look at the heat map, looks like Apple's picking up a nice little rally. Nvidia's rallying. Amazon, Tesla, Google, Meta. That looks good. That looks good for the moment. Let's see if they can hold that rally. Hold on. Come on. You can do it. All right. So good to see you, Sergio. Cyberox, very good to see you. Thanks for joining. And just a reminder, if you're a member and you want to see a stock, let me know. If you're a paid member, let me know. I can look at a stock. If you'd like a stock analyzed, $5 super chat, I can analyze the stock, or I could analyze 3 stocks for you for $10. And looks like Mike, the dividend investor guy. How you doing? So you want to take a look at Path. I'd love to talk about Path. Let's talk about Path, and I'll give you my comments there. I have analyzed the company. I have I think a insightful opinion on Path. Let's take a look. So UiPath, let me close out a few browsers here so I don't clutter my workspace. It's up 1.5%. Year to date, it's down 21%, and then down 53% for the 1 year. What do these guys do? Now, it's interesting what they do. It is a company that is fitting the times. So part of AI is agentic AI, where you're teaching the systems to do certain tasks, maybe they're repetitive tasks, and then your systems can do it. Theoretically, we've already been doing that, and we call it something else, but we call it workflow, we call it code, we call it a lot of things. Machine learning. We've been doing machine learning for quite a while, like 10 years. So this is kind of a new way of looking at it, and there is incremental benefit, but it's not like, whoa, we weren't doing any of this and now we're doing it for the first time. No, it's an expansion of something that we were already doing. So these guys help you build agents, and and you think about, I don't know, maybe if you look at a production floor, and if you guys are familiar with production, as product gets built, you have work orders, and these work orders have assemblies or tasks, and they have sub-assemblies, and people do the work, and usually you have to assign materials to a work order. You have to do all these transactions in your system, and maybe you can teach your systems to do that for you, and then you don't have to deal with that. Or it could be expense management. There's processes within organizations that this could benefit. So got it. Again, we've been doing that for a while. These guys just claim to do it better. So that's what UiPath does. They came out with a lot of fanfare. And it's a good chart to look at, because these IPOs, right? We haven't had a lot of IPOs, but this IPO, if I recall, came out with a lot of fanfare, and then, whoa, look at that. Man, if you bought when the IPO'd, you'd really be hurting. Your investment's down 87%. Not good. So I don't invest in IPOs for this reason. Most of them, even Google and the awesome companies that we see today, they tend to have this experience. They go down and then they eventually go back up. I'm waiting for the eventual going back up if it's a good business. So this one here has been a real loser for investors. Now, when we look at their revenue growth, the revenue growth is okay. They're fairly small, 1.4 billion, growing at 9.13%. So when you're this little, and for the most part, these guys, I put them, and I think they're classified as a software company, right? Software infrastructure. That makes sense to me. So when I compare them to other software companies, I could find a long list of companies that have this growth rate that are software businesses. So this isn't a special company. And now, if you're growing at 60%, you're special. If you're growing at 30% or higher, you're special. You're in that special category if you're about this size. So the revenue is okay, but it's not great. Free cash flow, 305 million. That's good. That's pretty good. And I would probably value the company at like 6 billion using this number. And gross margins are very good, 83%. That's a software business. That's why I like software. They're really profitable. I like profitable companies. They generate a lot of profit, generate a lot of cash. I like them. I like those businesses. Now, I think their balance sheet's in good shape. Let's take a quick peek just to make sure. Yeah, they're in great shape. They have 1.65 billion. So I would say they're worth 7.58 billion to me because they have that slow cash, slow growth, excuse me. So they are discounted. So if we look at this company, they are currently discounted. Let's do a full valuation on this and kind of get some more precise numbers on this. So this is investing. I went from disliking these guys because I still remember this. They were still priced too high here to, hey, these guys are discounted. Now I might be interested because I think software businesses are really good. These guys are embarking on a good space, a good fertile space of growth. They could use little better growth, by the way. Let's look at the quarterly. See the quarterly slowing down. Why are you guys slowing down? You guys picked an area of the market where you're supposed to be growing faster. Now get out there and grow. Enough of this single digit stuff. Show me 15% growth at some point. But enough of the coaching. Let's get into evaluation and figure out the valuation on path. Oh, I don't have one there. So I'm going to use DocuSign. DocuSign's been a winner for me. They're a software business. And we're going to use that as kind of like the starting point, kind of a template, like starting point. And we will take a close look at path, see what kind of discount we got with that business. I'm going to start following it because that is a pretty good rate of cash flow that I saw. They don't have any debt. Their growth is okay. They better they should start growing more. Got to figure that out. All right. So today's date. So UiPath hasn't been around quite as long as DocuSign. You saw the declining revenue growth. That makes me a little worried. So I'm going to go to 8.5 on that. They were at $305 billion of free cash. They were growing it nicely. And they're growing at 9%. So I'm going to grow it at 9%. And that'll be plus 305 times 1.09. Okay, so this is my cash forecast for UiPath. They're going to keep growing that cash. And they have terrific margins, 83%. Beautiful. 83%. That is great. They're in a fertile space. They could be acquired, by the way. That is a space where other software companies may be really interested in buying that little business. So the intrinsic value is 7.8 billion using those numbers. They had a fair amount of cash. Let me take a peek at their cash again. And they have $1.63 billion of cash and $78 million of debt. All right. And how many shares outstanding? They have 551.49 million dollars of shares outstanding. All right. So you see that nice discount, 69% discount. That looks really good. That's a good business. It's growing. And right now, things are being sold off left and right, whether they're quality companies or not, being sold off. So interesting. Their earnings per share. Let's take a peek at that, update that. Now, software businesses have a higher PE, and because they have those high margins and they have proven to be value creators over time. Just look at Microsoft. It's the most valuable company in the exchange now. They're a software company. So they have an 18 PE, 16, much better PE. I'm going to use the 18. Earnings per share is 55 cents. 26 analysts agree that's going to be their earnings per share. It's going to grow a little bit, just a tiny bit. Okay, so 55 cents. 18. Okay, so it's fairly priced based on earnings per share. Overall, I think this is a buy for me, and it's a good-looking little company. You know, little companies are going to start to be acquired because, especially, and it's not going to happen immediately because we have tariffs. You know, a lot of things need to get resolved before businesses are going to start making big bets. But another software company that wants to keep getting bigger, because as they get bigger, they get more profitable. This should be a nice little acquisition, UiPath. So interesting. So these guys here are discounted. I'm going to track this stock. I'm going to watch it. And I think it's a really neat little company. Remember what Howard Marks said is he's made a lot of money buying stocks right, getting the right discount, not necessarily picking like the best, company, the most popular company. It's about picking investments that are going to give you a very good entry point on your investment and then watching that investment go up in value. Still has to be a quality company that I expect is going to do really well over time. But this one here looks good. Looks good, Mike. So hopefully that gave you one more opinion on that investment. And hopefully that was interesting to you. I'm going to update this form on the folder, and I'm going to do that today. And that'll be in there. So if you want to refer back to it, you will have a working copy of UiPath. Thanks, Mike, for asking about Path. All right, excellent. So let's take a peek at the market. NASDAQ, making it happen. I like seeing that. We're just a half hour into trading. We'll see if it could hold that level. And we are going to see, over, you see that, man, look at that drop. If we look back in 2022, what normally happens is you have a declining market. The NASDAQ went down close to 35, but you see these bear market rallies here. I mean, that was a pretty good rally there. And you see this bear market rally here. That was a pretty good rally. Look at that. I thought we were out of the woods there. And then boom, came back down further. So we're going to see rallies. Okay. Now, does it mean we're out of the woods? I don't think so. My opinion is until the tariffs get resolved, we're going to have a market that is declining. These bear market rallies we could use in our favor. If you're looking to create some cash and maybe there's a stock that you're like, I can lighten up a few shares there just to create some cash. It's a good day to do it. Good day to do it. I'm doing that with one stock right now. I want to lessen my number of shares I own. So I'm probably going to end the live stream and head straight to that stock and trade it and sell off some of the shares. So that looks good. What else did I want to cover? I think we're good on that. Looking at the heat map one more time. Yeah, there's some good green out there. All right, fingers crossed that it could hold these levels, and we don't lose too much more, because it's kind of been a little disappointing to watch my portfolio go down. And again, these super investors, it's been really like I've been tracking these investors, and I track their exact investments. Like here's Buffett. I had a lot of questions around, well, what are you talking about? The Berkshire stock is up. Yeah, the Berkshire stock is up. but his investment in Apple is way down. His investment in American Express down, right? He has a couple winners in there. I'm tracking his portfolio. I'm not tracking Burke. So even the great investors, most of them are underperforming the S&P. So it's good. It makes me feel like, okay, if I keep getting better and better, I'm going to outperform many of these super investors, and I'm going to do better for myself, and I'm going to be more capable. I'm going to be able to make better investments and grow my wealth and take care of my family and have fun in life with the money that I have. So to me, having this scorecard has been productive, and I'm going to release a video on Carl Icahn. I was pleasantly surprised with the performance he has. I'll release that later today. And I was going into this thinking, okay, this guy's probably going to be a laggard. Nope, he's one of the leaders. So that's what I get for taking kind of an opinion into the evaluation. And I was pleasantly surprised by his return. So all details will be on the video that I release later. Michael Burry is still on top this year. Of course, he had some kind of a couple bad years in the past. Tepper, big in China, big on healthcare. He's doing okay. Howard Marks, just underperforming the S&P. Buffett, underperforming the S&P. The ones that are really concerning are Pabrai and Wood. That's a tough. You see these numbers changing. I've set up these valuations so I could easily update them from quarter to quarter, and the share prices update and so forth. So I'll be able to kind of keep track of it. I think that'll be interesting. It'll be interesting to me. I hope you find it interesting as well as I make videos on it. All right, guys. So thanks so much for joining 35 Strong on the live stream. Again, I welcome you to join my channel. You can go to my homepage on YouTube, click this join button right here, and it will give you the options of memberships. There's 3 levels. There's perks on each level. I think it's really worth it, and I welcome you to join. And part of that is, the tools you just saw me use. You get access to them, and you get access to 3 calls. And these are live streams, but we have 3 member calls, one on Tuesday morning, one tonight at 8 p.m. Eastern, and then one on Sundays at 1 p.m. Eastern. And we talk through stocks. We talk through topics. We have some new investors that are getting going. They have a lot of good questions. We talk through that. And really, it's a forum to, up everybody's game on investing, becoming better investors. And I welcome you to become a member. It'd be great to have you, especially some of you guys that have been on my live streams for, 6 months, a year. It'd be great to talk to you for the first time on one of these conference calls and get to know you even further. All right, everybody. So I will land the plane on the live stream. Let's hope that this market continues to go into the green, deeper into the green. It'd be great to have a good day. All right, everyone. Good luck with your investments today, and I will talk with you soon. Take care.